Before transforming these values into more presentable numbers, let's plot them on a graph. No surprise, this can be done easily with just a couple of lines of code. From the newly created simple return column, we can obtain a plot with the size of the figure of, say, 8 and 5. These two values won't affect the labels on your graph. They simply determine the size of the graph in the output field. Basically, in this cell, we asked Python to create a graph. If we executed, the plot won't be immediately shown on your screens. The way we do it is to apply the show method. Let's run this cell. Beautiful! Did you expect some sort of a line graph? Well, that's not the case, as these are simply the daily returns that were observed throughout the period. Quite often, positive returns have been followed by negative returns. As you can see, the most significant daily observations were mainly negative. In finance, we are accustomed to seeing negative returns that have a much higher magnitude of positive returns. Usually, positive returns accumulate over time, and stock prices increase. But when things do go wrong, stock prices tend to fall very quickly, as you can see here, a loss of 30% in a single day. However, an investor who is interested in buying a stock and holding it in the long run is mainly interested in the average rate of return that the stock will have, right? Let's calculate the mean return of P&G throughout the period under analysis. A method called mean allows us to obtain the average daily rate of return straight away. This number looks really small. It is much lower than 1%. Is it possible to interpret it meaningfully? Well, an average annual rate of return will tell us a lot more, right? Remember the following trick. The data we extracted is not composed of 365 observations per year. It excludes non-trading days such as Saturdays, Sundays, and bank holidays. The number of trading days per year is around 250, sometimes 251, at other times 252. So, let's use the number 250. I will multiply the average daily return by 250 and will obtain a very close approximation of the actual average return per year. This value looks more credible, doesn't it? Let's round it a little. To make it more presentable, we can multiply it by 100, turn it into a string, and finally add the percentage sign at the end. Here's our great-looking output. In this video, you saw how to estimate simple market returns of a given stock, how to plot it, and how to turn it into a meaningful value that is easy to interpret. That's a great start. Take a little breath, and in the next lecture, we will analogically calculate the logarithmic returns of the same stock. Thanks for watching.